we have with us 3 of our equity managers who are buying, purchasing, owning properties long term. And specifically, just quick introductions, because each of them actually focuses on a very different niche of the real estate market, so it should be interesting to get their thoughts on these different areas. So Shawn Clark is with USLF, is how some of you might know it. Also CRG, Clayco, they have a lot of names, so just say hey you, and then maybe he'll respond to that. But they focus on industrial properties. They build large, modern industrial properties. Think those used by Amazon and Walmart type of buildings. Meghan Gutnikov is with KCB Management. Many of you here are familiar with KCB Management. Morton's been investing with them for over 2 decades. We've been in all 8 of their real estate equity funds over the years. And they are very much generalists. They will look to invest in different areas of the real estate market depending upon what's attractive, what's available at any given moment. So. And then Todd Williams is with Grubb Properties. Oh, that was exciting. Grubb is focused, they're developers of multifamily or apartment buildings. And their key area of focus is what they call essential housing. So building apartments for typically young professionals, things that are a little bit more affordable in certain markets where there is a lack of that today. So today we're gonna delve into a number of different things related to real estate, but starting out, just talking a little bit about the challenges that the current market faces, and then get a little more, I promise, more cheerful into the opportunities. But in terms of the challenges right now, anyone in here own investment real estate? All right, how about your homes? Everyone own homes? It's interesting for those who might just own their homes versus owning both. It can feel very different because right now, in Southern California, housing prices are at all-time highs. So the real estate market's doing great. On the commercial side, though, and especially if you're looking to transact, buy and sell, it's been really challenging the past couple of years. And all of it's driven by interest rates. So interest rates were at all-time lows. We had the fastest rate hiking cycle in history. And that really created a lot of challenges because real estate is such a heavily driven debt investment, right? The cost of your real estate is that better? I'm not usually told I'm quiet, so we could also just go with the time. The debt that you use to buy real estate makes the interest rate part of it just really impactful, and even less impactful on price, more just even in how you operate. So let's say you have a $10 million property. A couple years ago, you'd go borrow $8 million from the bank. You had a really low interest rate. The income from that property covered the debt service, no problem. And then you fast forward to today, and maybe the bank would say, hey, we'll refinance that, but we're going to give you $5 or $6 million, and all of a sudden your income doesn't cover it. And so it's been really tough for a lot of different kinds of properties. Let's say commercial properties broadly, if you're going to paint it with a really broad brush, down maybe 15 to 20% from previous highs, and certain kinds like office, things like that, much worse, as many of you know. So let's go ahead and maybe get into your specific areas of focus, because again, we have a really good wide variety here, and just talk through kind of what the recent history has been like with what's happened with rates. So we'll start with you because you're closest.
Okay, great. I'll give just a little bit of a bigger backdrop for the USLF, CRG, Clayco perspective. Clayco is sort of the top co, and its main business is construction. So we kind of live inside of a construction atmosphere. CRG is the real estate development business. That's one of the subsidiary companies of Clayco. And then USLF is our fund vehicle that invests into the ground up development of industrial assets across the United States. Our business, CRG, has 7 regional offices across the country that cover from Philadelphia doing the Northeast region, Atlanta doing the Southeast region, Chicago with 2 partners that cover the Ohio Valley and the Midwest regions. St. Louis kind of helps with that as well. Phoenix in the Southwest, LA, Culver City for the Inland Empire, Southern California market, and then in Seattle as well. So we're geographically diversified in how we pursue that. I think the question was specific to interest rates, or
well, even just industrial.
Just overall.
Industrial had a really hot run for a very long time, was incredibly strong, and it was not immune from interest rate rises.
No, that's right. So we're just to paint the picture for those who don't live in industrial real estate every day. The industrial real estate asset class was benefiting from e-commerce and was in a really strong position way before the pandemic had happened. So coming out of 2013, really the rise of Amazon, 2014 and 15, what you were seeing was demand for a modern industrial facility. And what that means to me is larger buildings, so maybe normal sized buildings in the past for 300 to 500,000. I mean, obviously all the way down to 50,000. But the new buildings were 1 million square feet plus. Taller clear heights. These buildings were no longer 28-foot clear, 32-foot clear, 36-foot clear. They're now 40-foot clear from the floor to the ceiling joist. Way more car parking. 1 million square foot building actually needs at least 500 car parking spots, and tons of trailer storage to meet sort of the e-commerce needs that are happening. And so if you think about all of the industrial buildings built before 2010, they didn't have those features. A developer would build the biggest building that they could on the piece of land that they had. And so now, stepping back, you needed a bigger piece of land to accommodate all of the site circulation and the parking and the things that I just described. So there was massive demand for these new facilities prior to the pandemic. And then the pandemic forced everybody to go home and really didn't create a new trend. It put fuel on the fire for the trend that was already happening for folks buying online. So just also painting some backdrop is history. 2018, 2019, maybe 200 million square feet of annual net absorption of industrial buildings in those years.
And when you mean absorption, so people leasing those buildings.
Perfect. And not just total leasing. The total leasing might be, call it 600 million, but 400 million of that might be someone moving from one building to another or releasing space that they already have. When I say net absorption, it's new space being absorbed by growing tenants or new tenants. And so it was about 200 million, 100 to 200 million a year prior to the pandemic. 2020 was 300 million square feet of net absorption. And then 2021 and 2022 were both over 500 million square feet of net absorption. So what you saw was massive demand, but at the same time, sort of a delayed reaction, but a lot of new supply out to go meet that demand. And so we reached a spot now where in 2023, we still had over 250 million square feet of net absorption, but we were coming off record supply. And so you have a little bit of supply that's being burned off today, and then combined with the Fed rate hike, sort of slowed leasing decisions, sort of in anticipation of a potential harder landing. And really the positive of all of that is the cost of debt has changed the capabilities to go start new development. So new development starts are way down. And
so with that, I think we'll get maybe this more in the opportunity section, but the idea being that there's going to be less supply in the future, so existing buildings or what you can build will be more valuable.
That's exactly right. So the new supply coming online is under 300 million square feet is under construction, which is as low as it's been since 2017. And so that's a good thing.
Thank you. I'm actually going to do Todd next because we'll get specific, and then we'll let Meghan do a broader view. But apartments really, to a large degree, I think were touted as sort of this safe haven asset class. It almost felt different from other kinds of real estate where that's secure, it's safe, but not immune from interest rates. And even in particular where you guys are building, I think there's been challenges.
Yeah, let me just start with kind of the context of multifamily housing. Really, starting almost a decade ago, we've seen unparalleled demand for housing in general, in particular for multifamily rental housing. We've been really, over the last 10 years, and probably likely for the next 10 years, we will underbuild housing in the United States. We have about a 3.5 million unit shortfall, including both single family and multifamily housing demand. So that's sort of the backdrop. But the last 5 years have been probably the most volatile years, at least in my career. And if you think about kind of the major events that have occurred over the last 5 years, they've been volatility in good ways in housing and volatility in bad ways in housing. And I'll just kind of march through them, and that might be helpful as context. So first, obviously with COVID, we had very significant changes to the availability of construction materials. For example, wood trades on a linear 1,000 board foot metric. And that metric in 2019 was about $280 a square foot. A little bit of volatility, but around that number. It had spiked post-COVID to over $1,400 per linear 1,000 board feet. That was kind of the volatility we saw early on. So inflation became a real issue that was further fueled by both fiscal and monetary decisions. Inflation, by comparison, and a great example of this in terms of how it affected housing for us, is a project that I like to use as a great example of inflation in Chapel Hill, North Carolina. So Chapel Hill is a market where we own significant assets, and we were building a 4-phase Link apartment project. Link apartments are our national brand. Our first phase cost us $238,000 per unit to build. We constructed that or priced that in 2019 and delivered it in late 2020. Fast forward just 2 years later, our second project we constructed for $285,000 per unit and delivered that in 2021. I'm sorry, in 2022. And the last phase that we priced but have not started construction yet, priced at $348,000 a unit. So in the span of, call it 3.5 years, you're talking about over $100,000 per unit increase in the cost to produce housing. That's what inflation, that's the impact that inflation had on the housing industry, at least in the multifamily rental segment. Fast forward then to the Fed's response to that inflation. That caused, as Meghan said at the outset, the fastest rate hike in modern history. So that rate hike, to put it in perspective, moved SOFR. SOFR is the benchmark index for most construction financing by over 2,200% in less than 17 months. We've never seen anything like that. And that created a lot of challenges in our industry, as you can imagine, because interest is also a cost element. You have interest reserve as part of your construction cost, and then you ultimately have to pay interest even post-occupancy prior to refinancing that property. But not only did short-term rates go up, affecting construction interest rates, but so did long-term rates. And so the example that Meghan gave earlier on refinancing also became a problem in the multifamily industry. Now, one of the ways we mitigated that was we used a lot of long-term fixed-rate construction to permanent debt. One of those vehicles, for example, that we utilize often is a program called a 221D4. It's a HUD program. That's a construction financing rate that's typically 70 to 80 basis points inside market rates, and it's a 40-year amortization following 2 years of construction interest.
And how many of your children do you have to give up to actually get that loan?
Well, it is a very difficult loan to get, and yes, I think my firstborn is pledged to HUD at this point. But that financing's really interesting because we've got several loans that have 2.39%, 2.89%, 2.82% type financing rates. Fully amortizing over 40 years. And by the way, these loans are assumable. So I can sell the loan with the property. And so many of those properties, while the valuations are way down, the value of the loan is now an asset and can be sold with those properties. So that's one way we've combated. Not been able to do that on every property. Many of these HUD loans, as I think Meghan is alluding to, can take 15 to 18 months in some cases to secure, and you have to be obviously qualified with a lot of experience with HUD. But that's one way we combat against that. And now what we're seeing is obviously a Fed pivot. We'll talk a little bit about that and what the impact of that will be on the opportunity set that we see right now.
Meghan, for you guys, I'm curious, since you have some exposure or at least view to a lot of different kinds of real estate, what was sort of most resilient through some of the challenges, and then even, where were there interesting opportunities, or we'll get a little more I get excited. The other piece, though, is I think there are a lot of investors who have been on the sidelines, kind of more short-term investors, and so the dynamics of your market have definitely been shifting as well with the interest rates.
Yeah, so we are a long-term, cash flow-oriented, opportunistic investor. We partner with best-in-class operators like Shawn and Todd across the country, doing everything from ground up to stabilized type deals. And like Todd, we like to go in having long-term fixed rate debt so we don't have that volatility for a long-term hold. So if we look at going back to when COVID happened, we really were on the sidelines from an acquisition standpoint and became a very active seller of our real estate. And I should step back. Something that's different from our peer group is we create our fund vehicles in a way that allows us to hold indefinitely. So we have the ability to sell in markets when they're hot and be buyers when the markets are a little bit softer. So we became very active sellers of our multifamily properties because prices were extremely high. Well, why were they high? Partly because some of our properties were seeing double-digit rent growth. Also, interest rates were extremely low, debt was affordable, and we were concerned at the time that there was this eviction moratorium. So essentially, if we had tenants that stopped paying rent, we were not allowed to evict them. So we were concerned that we were going to start to have lower cash collections and have to support these apartments if that ended up happening. So we had very nice exits for most of our multifamily properties that we sold during that time. Switched to 2022, when the Fed started escalating rates, we also saw lenders expanding their spread, as well as giving us lower proceeds when we were buying properties. And this really had an impact on volume. So in 2022, there was about 400 billion of transactions that took place. 2024, that's expected to be about 150 billion. So only about 40% of what it was just a couple of years ago. Well, that's an issue because there's very little pricing discovery. So when people are going in to try to value assets, they don't have a good precedent transaction to look at to say, this is how much we think that we can actually sell our property for in a couple of years. And most of our peers are looking at 3 to 5 year hold periods at the most. And so not only are they having an issue with trying to figure out what their cap rate would be when they exit, unlike being in Shawn's place, I think at the time, which got the benefit of the e-com boom, a lot of property types started struggling from a rent growth standpoint and ended up, in many cases, declining. So you had declining rent growth and higher operating expenses. So not only could they not figure out the exit cap rate, they also didn't know what their net operating income was going to look like in the next few years. For us, because we're a long-term holder and we like to go in with the assumption that we're comfortable holding these properties forever, we've always used historical growth rates over several decades when determining how we're going to underwrite these deals. So we're focused on cash flow generation over time. We know that there's going to be some years where there'll be softer growth and other years where there'll be more robust growth. But at the end of the day, it should normalize. So with our peers on the sideline, we were able to become much more aggressive from a pricing perspective because sellers really didn't have many options. And they were struggling with how, from a seller standpoint, do we refi and we put in cash in? Because the new loans that were coming due were much cheaper than where they are today. Some had life cycle issues where their LPs needed to exit. So we've found some really tremendous deals in the last couple years. They tend to look like strong cash flow going in day one, high cap rates, really accretive leverage. And while we don't underwrite to predictions of what's going to happen with the Fed rate going forward, we do know that the Fed has a target of 2%. And so we should, over time, benefit from interest rates and hopefully more affordable debt.
Thank you. I think what we've seen the last couple of years too, you alluded to this about the short-term investors. So a lot of people just waiting. So just on pause where they almost didn't know what to do. And that definitely translated, now we get the opportunities, into the, I think, industrial space a little bit, where you saw some of the big tenants, even Amazon was like, okay, let's pause this. And if Amazon hits pause, it's like, is that the end of the world? Are we going to continue? But I think they're back. So kind of what's the outlook, I guess, going forward for this sector of the market?
There's a lot there. I would say yes, they're back. Giving some history to it, Amazon was the first to take a lot of space in the e-commerce race. They were also the first to sort of admit when they had overbuilt and overleased, so they were the first to stop. In good news, earlier this year, they were sort of the first to get back in, and so they've leased over 18 million square feet in the first half of the year. I don't have the latest figures. I was trying to find them for what's happened lately. I do know lately, as a matter of fact, that AWS has been on a complete tear. Our company is building over $2 billion of data centers for Amazon Web Services right now, and that's a whole another topic. But they are back in the market in a meaningful way. I'd also add that after a good 12 months of slow decision making by tenants and really delayed LOI signings, delayed lease signings, we have executed 4.5 million square feet of leases and LOIs in the last month and a half or 2 months, and across our portfolio, and we continue to see even more opportunity every day across the portfolio. So it does feel like tenants are back in the market and making decisions again. I think I would give, are we in the good news section yet?
Good news section.
Oh, okay. So, and just another kind of spot point, we feel like we're at the bottom of the market and coming out of it for sure. I think the rate cut that Todd alluded to is obviously helpful. We have a data point, for example, that we had sold, and Meghan wanted real examples, so I'm going to give a real one. We sold a legacy asset, turned out to be a really great exit for us, but it was the Amazon deal we did in Phoenix. We sold that about 6 months ago at like a 5.7 cap rate, and we're getting guidance that a different Amazon with the same term, a 10-year term, is going to get awarded about at a 5.35 cap rate.
And just this microphone's exciting. For people who don't know, cap rate is basically, it's used a lot, but it's the without debt, what's your yield from a property? So when it's a higher cap rate, it's actually a cheaper price, and vice versa. So basically, they were able to sell at a good price, and then they're seeing that even prices are continuing to go up.
Just like bond yields, when interest rates go down, the bond values go up. So pretty meaningful, about 35 basis point reduction in cap rates, following a 50 basis point reduction in the Fed rate. So I think that's good news. At the same time, just for another data point, I know in Columbus, Ohio, there's a 1 million square foot Class A sort of high credit tenant, not our deal, but that we think is going to sell at a 5.75 cap rate. So that's Columbus, and in Columbus as well, there's another 1 million square foot deal that only has 5 years of term on it, lower credit, and we're hearing they can't get anything better than a 6.5 cap rate. So there's definitely money today for, and this is just sort of how we see the cycle go, there's money today for the high credit long term, but once there's not many of those, so once those get bought up, we see pricing coming in for the rest.
So where there's more security, good tenants in place, they're locked in, they are People are buying those. They're back in that market specifically.
Yes.
And I think we've seen that too, where the Fed rate cut felt like something that a lot of people were waiting for. So Meghan, I don't know if you've seen people starting to come back in, and then also just in the vein of opportunities, I know senior housing is something you guys are looking at a lot, but what are the interesting segments right there today?
Yeah, so just to piggyback off of Shawn's point of kind of seeing this trough and now pricing pick back up, we actually follow the Green Street Commercial Property Price Index, and it essentially trends property prices over the years. So if we go back to GFC, the down point was about a 31% drop. If we look at where it was end of 2023 to today, it's around a 28% drop. So this is the time to be actively buying, which is broadly across all property types. So it's not just one in particular that we think is extremely discounted, even though we know there's out of favor property types today, such as office.
Sometimes there's a reason they're out of favor. So that's
Yeah, but to Todd's point, I mean, there is a national housing shortage. We know that there wasn't a lot of new construction that came online, and so we like apartment exposure over time. There's strong long-term fundamentals there. We also like senior care. With the baby boomer population aging, we know that there's going to need to be more supply to keep up with that demand.
You know, Meghan, it's interesting you mentioned the Green Street Index. There's a small emerging manager called Blackstone that did an interesting piece a couple months back. Well, I guess it was back in July. And the title of the piece was called Investing Before the All Clear Signal. And the thesis behind it was essentially that we are in this trough and that, you know, you have to look at the numerator-denominator effect, right? The fall is pretty significant, but the opportunity coming back and the recovery is very, very significant from a valuation perspective. So, you know, I don't often reference emerging managers like that, so pardon that. But on the housing side, you know, in terms of opportunity, we think of kind of a couple of things, really a tale of two cities right now. And, you know, following the pandemic, we had population migration changes, albeit temporary, and we also had capital flow migration, some of that temporary as well, some of it more permanent. That created different effects in different cities. And so in early 2019, we had started looking at gateway cities like New York, DC, LA, San Francisco as examples, because these were markets where housing was very, very difficult to procure. And we felt like, you know, being long-term housing investors, why wouldn't you want to be in a place like that, right? And then the pandemic changed all that. And we saw temporary population migration go to places like Texas and Florida, and of course to the Carolinas where we are. And like you, we sold, you know, portions of historic portfolios at incredible values in 2021 when we were seeing 18%, 21% year-over-year rent growth in Atlanta, Charlotte, Raleigh, Nashville, you name it. But what happened is that became a buying opportunity in some of these gateway markets. And so in, you know, places like New York and LA, we went in and bought sites and started working on development, and with the bet that these markets would be coming back. We've been incredibly right about New York. We've been not so right about San Francisco so far. And so that's been a little bit more of a challenging market for us. Although I'm confident that San Francisco will be back. It's just taken a lot slower than we thought. LA's more in the New York camp. DC felt a little bit more like San Francisco. But now DC just saw 11% year-over-year rent growth in the second quarter. So we're seeing these markets start to normalize again, and that's powerful for those sites that we acquired. And so one opportunity is to continue to build in those markets where there is really, really restrictive housing. However, the opposite is true in some of the growth markets, like in the Southeast, where there's been temporary oversupply. So take a market like Dallas, Texas. I think they have something like 78,000 units under construction right now. Now, it's a big market, 380,000 unit market, but 78,000 units is a lot to absorb. A market like Charlotte, North Carolina, where I flew in from, is has 17,000 units under construction and regularly absorbs about 7,500 a year. So some of that's coming off. We know it is because new supply, new starts in housing dropped significantly, as I think Meghan alluded to. And so as a result, 2026, 27, 28, and all of these markets look like they're going to be banner years for multifamily rental housing. But 2025, for example, in some of these Southeast markets may still be a little bit rough. So as you can imagine, from an opportunity perspective, we've got kind of three. We've got our existing portfolio, which we want to hold and participate in that recovery. We've got some select development that we want to do in markets like New York or LA, where we think we can get it to work and where there's significant housing shortfall. And then we've got markets like the Carolinas, where I would love to buy some more assets at that $238,000 a unit price tag, which is about what you can buy some of these assets at today, even though it costs $350,000 a unit to build them. So that's the discount to replacement cost that we like to look for acquisitions.
I'm going to ask you all about the election, but no one say who you're voting for. We're not gonna. I think it's interesting how the election, obviously there's so many different pieces involved with it, but real estate isn't immune from that in terms of both short-term volatility, but also potentially positive things that can come out of it. So maybe, I guess, Meghan, you want to go first, pass it down the line of how does that impact
Sure.
what you guys are seeing today, or even end of the year type rush?
Right. So we have seen a flurry of deals with sellers who have been more flexible on pricing. And really the goal for them is to have a surety that there's a closing that's going to happen before year end. And their concern is, depending on who wins the election, the capital gains tax could go up. And so the net tax return for them, even if they were to hold and get a little bit higher purchase price, will still be lower next year than had they just go ahead and sell today. For us, we do not make decisions based on what we think is going to happen in the election. We hold long term, so it all depends on when we're selling in the very long future.
I think, Shawn, you had an interesting example of a deal that you got to take advantage of someone panicked, but or 8 years ago.
Yeah, and I think that was perfectly outlined of what the fear is. And we did have a seller in the last 4 years ago, I guess now, which is crazy to think about, but who was nervous that Biden was going to win and raise capital gains taxes for several hundred acres. It's actually that same site that we sold the Amazon on that I was just telling you about. That land, we were able to buy that land at a steep discount because the seller wanted a year-end close before the election would happen. And that really worked out in our favor. We also don't make any net tax decisions. We think about the market holistically and don't want to be provoked by what's going to happen in an election and the volatility that can happen with that. We think a little bit longer term, even though our development period and hold periods are still meant to be 3 to 5 years, but we don't need to do anything rash.
From more of a long-term standpoint, some of the fiscal imbalances that we're dealing with from a political standpoint, I think also we'll see how it unfolds as it relates to inflation and to real estate. Todd, I know that you've talked about this a lot, where the Fed brought up interest rates to combat inflation, but specifically in real estate, which is a big piece of actually the long-term inflation numbers, it had to some degree the opposite effect.
No question. I mean, to me, neither party has really addressed the fiscal side. In fact, if anything, fiscal side's been fuel to the fire for inflation, and that's been a real challenge, as some of the examples I gave earlier. But the monetary side has been a roller coaster. So we had, zero interest rates forever, and that created, a fairly artificial environment. And then we had, an incredible spike in a very short window of time, and that created calamity. We literally lost the capital debt markets for a better part of a year. We had a regional banking crisis that everybody's forgotten about by now. Maybe not so much over here on the West Coast, but that literally shut down the debt capital markets and the equity capital markets. They weren't even around at all. And so 2023 is like a dark year for us in the real estate industry because you just couldn't get anything done. That's changed enormously. So, we've seen, just to give you an example, I think in 2023 we did, I don't know, around about $140 million, a little bit less than that, of financings. To put it in perspective, by the end of this year, we will, in 2024, likely complete closings on over $1.2 billion worth of refinancings. So that's just the debt capital markets, that faucet being turned on, and it's made a meaningful difference. Now, the cost of that capital is extremely high, and in many cases, I can't remember if it was Meghan or Shawn pointed out, but the amount of debt proceeds available is significantly lower than it had been in the past. And so that means in many cases that you have to, in order to capitalize your project, seek some structured financing, meaning, layering in between a senior note and the common equity, what might be referred to as mezzanine financing or preferred equity or what have you, in order to fill in that gap, especially for midstream type projects. So, that's become an issue, but now we've seen, obviously, with the Fed pivot, and if Blackstone's correct and we're at the trough and going to hit a recovery, that likely means that we'll see further interest rate relief over the next 12 months, and that again will likely start a new real estate cycle. Real estate cycles are so interesting to me. I think, Shawn, maybe you and I were talking about this last night, but they are uncannily 16-year cycles. And I don't believe in just cycle theory for cycle theory reason, but the last four that I've been through, not excluding obviously the COVID issue, have been exactly 16 years, which is just fascinating to me.
How many years do we have left?
So exactly. Well, I was thinking we were over and starting a new 16 years. That's my thesis, anyways. So
I think that for you, Meghan, you can keep the microphone.
Sure.
When we're looking at a lot of real estate deals today, we've seen stuff where people are so excited about relative deal pricing. So people come in, they're like, "Oh, it was really expensive before, and now it's just moderately expensive." And so it's tough to get excited there. But I think that you guys see things that are a lot under the radar, because I'd say more the broad real estate market, you're starting to see this loosening up where there are opportunities, but it's not this broad-based thing where let's all go buy as quickly as we can. But I don't know if you can share an example of something you've seen that may be a particular case study that was attractive, or even a situation where because it was smaller, that's why you guys got a better deal.
I need to think through that a little bit. So our deal volume actually doubled between 2022 and 2024, and that was partly because our peers were sitting on the sideline and they were having a hard time figuring out what the future was going to look like. And in 2022, 2023, feds were still increasing rates, so no one knew what was going to happen and how quickly it was going to come back down. So we could be very, very selective of the deals that we did and really drive the purchase price that we were willing to accommodate. And that also was partly driven by what available proceeds there were. So like Todd, we also have a relationship with HUD. We've done over 40 agency loans at this point. So we were getting pricing that was much tighter than most other groups would be able to get in the market. And because we're opportunistic, I mean, we were buying actually a lot of single tenant, absolute triple net lease deals. So the tenant pays for all expenses. And for something that we would normally never be able to access.
What kind of property?
Industrial. Yeah. So industrial has been something that we've always wanted to get into. We really hadn't had an opportunity to until the past couple of years, and that's been the majority of our purchases.
And what's your target return profile on those acquisitions?
So it's over a 10-year period.
Just the question is the target return and kind of the profile of what they're able to buy.
Yeah. So for a 10-year period, triple net lease deal, single tenant, we're in the mid-teens net to us, which is quite nice, over a 3x multiple.
Again, though, does that feel like it's something more, it's one-off versus it's something where everybody can go buy that today?
I think it's hard for other people to buy it today because their returns are based primarily on cap rates, and ours are cash flow oriented over time. So we care less about cap rate volatility because we have the ability to hold and then exercise in a market that's extremely hot or cap rates compress.
Do you take negative leverage to?
Never. We do not take negative leverage.
Yeah, there's a lot of, when they say negative leverage, the idea you borrow today and basically you're not making enough cash flow from the property to cover your debt cost, but you're really hopeful that in the future your rent's going to grow and it'll be enough to cover it, or that interest rates will come down and you'll refinance. And I think we saw a lot of that in recent years, and we like to say also that hope not a great strategy, but it's.
But one thing about these triple net deals is there's a built-in rent growth. You know, in the leasing that there's either 2 or 3, and that's grown. So, you know, one of the positives of all of these, volatility that has happened in the industrial space specifically is there was massive rent growth that paired with the inflation that was happening, and that rent growth really helped stabilize values even in sort of a tough interest rate environment where valuations were coming down on a cap rate basis, but the values of the building stayed high on a lease rate basis. And so we were doing deals 4 years ago with 2% lease bumps on an annual basis, but anything you've done really since 22, really late 21, 22, just with the inflationary activity is in the 3 to 4% annual rent growth, and that has a major impact on what if a buyer will even buy the property.
Do you have any favorites?
Of what?
Favorite properties, favorite areas?
Well, you know, one thing we don't. I'm kind of the industrial guy here today, but we are a large student housing developer, and so as it relates to sort of multifamily student housing, we're probably going to start 3 to 5 new projects next year in the $100 million average deal size range. I just delivered 2 student projects, one at the University of Madison and one at the University of Oregon. Both of them are 100% leased. I've already pre-leased my 2025 school year of the Madison project, 70% at 10%. Rent growth of 10% higher than what I'm currently getting in the building, which was already over the pro forma that I went into the deal with. So I think tier 1 universities and top 5 college conferences, we love that student play. Data centers are going to be the next big industrial hyped thing. AI, language learning models. We're talking about not just inference and sort of cloud storage, but we're talking about compute. And there's a massive change in what's happening around where these can be. They can be anywhere for the AI models. They don't have to have some latency. And so there's a power grab happening today across the country that we're participating in. And I still, fundamentally believe really strongly about industrial long term. We haven't lost our conviction there. We are getting more starts this year. We've gotten a lot more thumbs up from lenders and capital partners for land that we've been sitting on for the last 18, 24 months that we're going to get in production, that we're getting into production now. We have a closing this week in New Jersey. And so we have new product that we're excited about getting out of the ground.
I was just going to offer a little bit of a contrast to the, I think, Shawn, we were told to pick a fight. Yeah, okay. So.
I have this thesis on panels that it's a lot more exciting if someone fights. So if you don't actually pick in a verbal fight, one of you has to punch someone else. So we're done.
I just want to offer a little bit of a contrasting view on cap rates, because I think in really volatile times like the time we're in, we just don't spend a whole lot of time thinking about cap rates. And I know that sounds completely controversial with respect to real estate folks, but we focus on what's the per pound price we're paying for real estate. And so in that example I gave earlier, and I'll give a live one here in LA. I was just touring a site a couple of days ago that we're considering for our Fund 8, where we can potentially acquire a property for roughly about $350,000 a unit in LA. Now, this is a market that it costs $550,000 a unit to build. So that feels like a pretty good price to me. But, the in-place cap rate on it, it's probably a 4. But it's broken. It needs work. It needs fixing. It needs somebody to come in there and think about how to improve that project. Now, you could argue, well, maybe I should be paying $250,000 a unit for it, but I think there's a certain bottom to real estate, and some of that is driven by the discounted replacement cost. So we tend to focus more on that, especially in big volatile times, than we do on cap rate, because cap rate's just really hard to pin down when there's not a lot of trades happening, when you get a lot of noise with monetary policy like we've had, and when you have a lot of volatility in the equity and debt capital markets. There.
That was the fight?
I didn't have a response. It was perfectly said.
Perfectly said. All right. We have just a couple minutes left. Does anyone want to ask any questions in the panel? All right, let me solve that here first. You get the faulty microphone. Thanks.
There's lots of different food groups to the commercial area, and I know that you haven't spoken about the two dogs, which is office and retail, but you've talked about a lot of bright spots. So my question is the redevelopment or repurposing of office or retail for the different food groups you've been addressing, is that a blip on the radar, and is that something that's being considered?
I'm happy to jump in a little bit. We own, unfortunately, I guess I should say, about 2.8 million square feet of office. Now it's only about 7% of our portfolio, and probably next quarter it'll be 6% of our portfolio without me selling anything. But the issue, as I would describe it, is you've got kind of 3 classes of office right now. You've got trophy office, and we own a bunch of that, and it's doing exceptionally well. I mean, we're seeing leasing pace at record levels again in some of that product. Valuations are down, of course, because there's not a lot of transaction comps, but we're getting higher rents, and we're filling up those buildings. These are highly amenitized Class A office buildings. The opposite extreme is what I'll call Class C buildings. These are buildings that were on their way out last cycle, and this is going to put the nail in the coffin. They're done. They're going to land minus demo. That's the price they're going to trade at ultimately. And then you got a whole bunch of stuff in between. Think Class B product, and that's going to sort itself out as to whether it can be adaptively reused, and if not, it will likely go by the way of the C properties. Now, we have a little bit of a unique strategy in that we look for, when we're looking for office, we typically look for office that comes with excess land, meaning surface parking lots. And then we utilize those surface parking lots to build multifamily and share the parking. And so that way we generate 3 forms of subsidy for our housing and quite frankly for our office, which is we get free land for apartments, we get shared parking, so shared capital costs for parking between the 2 uses, and then reduced operating expenses for the sharing of that parking between the 2 uses. And so that forms kind of a subsidy. We're not executing on a lot of that right now. We've got one project in Atlanta that Meghan's probably well aware of called Lake Apartments Lake Park, where we got caught midstream in that execution right in the middle of all of this capital calamity. And so we had a lender pull out on the multifamily portion of it literally at the 11th hour and had to replace that capital with more expensive capital just to get executed. So yeah, office is a really tricky area. You could have stuff that's down 15%. You could have stuff that's down 78%. You know, I'm just.
All right, you could have 30. Casey, 30 seconds.
I get 30 seconds. So, I think there's a few interesting things happening in office, which is currently pretty much decimated except for the Class A office. One, Chicago's sort of the market that I know because that's where we're based. We actually we leased 100,000 square feet out of a 500,000 square foot Class B building, so in the middle, called the Jewelers Building, which is a really historic icon in Chicago. And we actually bought the building out of bankruptcy for $60 a foot, which I don't know what the demo price is, but we're not going to demo it. It's a beautiful building. And it's 70% leased. And so what we're seeing, at least in Chicago, which is really exciting, is that space being backfilled in a multitude of ways. We're going to put 100 hotel keys in our building. It's going to take up 100,000 square feet of the building. Between our lease and the hotel lease, we'll actually cover our debt costs and give ourselves time, and that'll be the amenity to the building. And then two, we're seeing a lot of affordable housing conversion. So in Chicago, there's a big program on LaSalle Street to convert and take a bunch of old. These are the buildings that should be taken down, Class C, and make it housing, which we desperately need. And then lastly, if you have the power, we're seeing, the Metas of the world happy to put racks in any building that'll give them power. So on top of that, just last thing, I think it's very interesting that Amazon's requiring 100% back to office starting in 2025. And you're starting to see CEO sentiment greatly grow, that it'll be 100% back to office over the next 3 years. And so this kind of reminds me of 9/11 when people said they'd never come back to the office. I've always felt like, long term, that's not a real solution to not be in the office.
It's interesting. It's true in New York as well. The investment banks are, back in seat, and when you go to New York, it's alive and well. San Francisco hadn't quite got there yet. But the interesting thing in that market is we're seeing some of these AI companies actually take space now because San Francisco's become so cheap. Which, of course, it was the exact opposite in 2019.
Thank you all so much for joining us. I think when we look at our portfolios in real estate is unique in the sense that typically investments we look at are either more growth focused or more income focused. And I think here we can have a wonderful blend of both, and they've been great long-term builders of wealth, I know, for our clients as well as yours. So thank you so much for joining us. The managers will be out by their booth. There's some near the fountain out there, so if you have any follow-up questions, please approach them. And thank you so much.
Thanks,